Hello, thank you for joining me today. My name is Chris Chapman. I'm a partner at a law firm called Mayer Brown. We're an international law firm and I'm based in our London office. I work in financial services, regulatory area, and also dispute resolution. And I am one of the global co-leads of our wider financial services practice. Today, I'm going to talk to you about product governance for insurance firms and specifically about the regulation of fair value. I think for the reasons that hopefully I can explain, this is one of the most important areas in insurance regulation today. And the way I wanted to approach it was, instead of reading through a whole lot of detailed rules and guidance, I wanted to try and focus instead on the core policies and principles behind the regime, because I think that is the most useful thing to help you understand how you can best comply with it. And at the end, we'll talk hopefully about some practical steps you can take to assist you with that. For this presentation, I wanted to start with my next slide here on some of the history. I wouldn't usually do this, but I think it's quite important here to understand the evolution of the regulator's thinking in this area. And for me, the evolution of the modern thinking of fair value all started way back in 2005, January 2005, when what was then the FSA took over for the first time the regulation of insurance distribution and insurance brokers. And at that time, there was a product called payment protection insurance. Now, some of you on the call today probably know more than you ever would have liked to have known already about payment protection insurance. But for those of you who are not familiar with it, it was an insurance product that was sold with loans, mortgages, and credit cards and other forms of consumer lending that would protect customers in the event that they were unable to repay their loans because they were out of work due to illness, redundancy, or for other reasons. And even back in 2005, before it became regulated, it was a problem product. So at that time, the FSA went and spoke to the industry about payment protection insurance, had a series of meetings. And at the end of that, it decided that the industry could continue to sell it, but it introduced some quite detailed regulations around how that needed to be done.